But let's talk quickly about some numbers. We have Shalby that's joining in now. They have the hospital business, as we know. They have 10 multi-speciality hospitals, 4 single speciality hospitals. They posted a weak set of Q4 numbers. It was a growth of 20% in the hospital business year on year, but it's the margins that contracted both year on year and quarter on quarter. Shanay Shah, who's the director at Shalby, joins us now to give us a quick update on the business. Shanay, thanks a lot for joining in. So, you did see a 20% growth, but can you tell us what was the surgical revenues in this quarter? And, is this a level or is this a growth rate that you can maintain in FY24?
So, hello, good afternoon. Thank you for having me. Yes, we have shown a 20% kind of growth. I would like to bifurcate this growth into the two major verticals that we have. The hospitals business, has grown about 12% on an annual basis. However, the way to look at it ideally would be that, because quarter one of FY22 was affected by COVID. If we look at the other quarters of quarter 2, 3 and 4 of FY22 and then we compare it to FY23, there has been a 20% growth in each quarter. So we are quite satisfied with the hospital performance with the 20% kind of growth. In the implant business, it is a business that we kind of invested in about 2 years ago. So it is kind of work in progress as we speak about it. However, we have made significant inroads in that business as well, because in FY22, we did a business of about 30 odd crores in the year. In this year, we have done more than 94 crores. So we have kind of tripled the revenue in the implant business. And the other major metrics, how we measure the implant business would be that, the components that we're manufacturing in the factory. So, we have kind of grown 2.5 times from 18,000 components in FY22. We have kind of crossed, about 44,000 components in FY23. So that's, the breakup of the numbers. On the EBITDA level, we have
just wanted to, sorry to interrupt you, but just wanted to talk a little more about the implant business. You said revenues have tripled, but in terms of a timeline, when are you looking at break even in terms of, on the profitability side?
Sure. So at the EBITDA level, we have been EBITDA neutral for the year. It's about a marginal EBITDA positive number that we have in this year. But in FY24, we are looking to further double the revenues from the existing 94 crores. We are looking to roughly double the revenues next year and have a kind of single-digit EBITDA margin because, we will continue to invest in some of these newer geographies. So the expenses will be at a higher level in the beginning as we speak about it, because we've just kind of received the approval for selling in Indonesia as well. So we're looking at Indonesia as a geography in the coming year, apart from the other geographies that we already operate in, which is the US, Japan, and India.
All right. Shanay, the other day we were talking about the similarities in the business of hospitals and hotels, and 3 key metrics really stand out. One of them is expansion, the second is occupancy, the third is average revenue per room, or in hospitals' cases, average revenue per occupied bed. On a bunch of parameters, you've done well. Occupancy year on year has jumped to around 46% from 40%. Average revenue per occupied bed too has increased by about 3.5 odd percent. Just wanted your thoughts on what is a sustainable growth rate that you can expect in occupancy and average revenues per occupied bed? Those are 2 factors. And the third one is expansion itself. You're looking to expand via franchise route as well. How many hospitals do you intend to have by the end of this year and the end of next?
Sure. So, Mangalam, you're absolutely right. Those are the 2 major metrics, that give you an idea of what the occupancy levels and the growth would be like. In our case, in FY23, the volume growth has been about 16% and the ARPOB growth has been close to 4%. That gives, on an average, a revenue growth of 20% in this quarter. And we believe that this is a sustainable kind of growth rate for us because, at the moment, we average about 580 occupied beds in this quarter. And we can comfortably do about 1,300 beds consistently occupied through the year with the existing 2,000 bed capacity that we have. So there is a headroom of doubling the revenue, in the hospitals business with the existing capacity without adding any more capex. So that is how I would look at the hospitals business. With regards to expansion, yes, there are two projects coming up. One is the Mumbai project and the Nashik project, which are both multi-speciality hospitals. The question you asked was also about the franchisee business. The franchisee business, we have 4 operational units as we speak. One is in Ahmedabad, one in Lucknow, one in Gwalior, and the other one in Udaipur. So we have 4 at the moment. We are looking at opening between 8 and 10 centers in this fiscal year in FY24.
Right. And, on the expansion itself, another similarity between hospitals and hotels are different brands at different positioning for each of these businesses. And in your case, you have the Shalby Orthopedic Center of Excellence, SOCE as we know it. You added 2 units in Gwalior and Lucknow. Just wanted to understand the financials of the same. How do they work, the unit economics?
Sure. So, Mangala, both are different kind of franchisee units. Gwalior is a franchisee-owned Shalby managed unit. So we don't, the P&L doesn't get consolidated into Shalby's books, but Shalby gets a kind of a management fee for the services that we provide. So, that straight away translates into the EBITDA. And for Lucknow, it has been roughly 4 months since we have started the unit. So at, the operating level, we are going to be positive in this fiscal year in FY24.
And you have about 200 crores of cash on your books. What do you plan to do with that money?
Right. So, Sonia, we have many opportunities coming our way at the moment, and we are very keen at looking at hospital acquisitions in Delhi and Calcutta. These are 2 regions where we are quite, aggressively looking at hospitals. And we are also comfortable with taking on debt as well, even beyond the cash that we have. So we would be comfortable with a 1:1 kind of debt equity ratio.
All right. And finally, quickly, before we let you go, 2 businesses which are doing extremely well on a low base. International revenue grew about 100% in the previous year. What do you look at this year? And same is the case for home care business, grew about 38%. Both of them doing about 10 crores each.
Correct. So the international business has grown about 2.5-fold, and in fact, this is one area which will grow much faster than the average hospital growth. And even though it's a small percentage, the way to look at it for Shalby would be that we are largely present in non-metro cities. So considering that, we are doing one of the highest amount of international revenues across pan-India. And talking about the home care business, yes, we are very aggressively looking at this business because it is not only about the revenues that we generate in the home care business, but it is also about the brand loyalty that comes in, and because of which it really kind of accelerates growth in the hospitals business. So yes, we have kind of added a lot of people in this business as well. We've kind of now have more than 100 people dedicated to home care across all our units.
Okay, all right, we leave it at that. Thanks a lot for joining in, and all the best with those acquisitions. Hope we get to hear about them very soon. That's the word coming in from Shalby. They're open to acquiring hospitals in Delhi and Calcutta, and they're open to taking on some debt as well for the same.